that's the history. Let's look into our Denver area 5-year forecast. Shown first is our estimate of distressed housing trends. You can see the numbers peaked 2008 at 9,521, trending lower throughout the forecast period. This is a market area that suffered somewhat of a setback in the 2002-2003 area with the dot-com bubble, but didn't have the same magnitude of overbuilding, the same magnitude of housing bubble in 06, 07, 08 that we've observed across most of the westerly markets. And that's beginning to pay some benefits. The distressed inventory is lower here as a percentage of the housing stock and lower here as a percentage of the transaction volume than many of the Western markets that we're experienced in. Here's one of the reasons why: current housing construction. You can see the peak years, 2001, that was a dot-com period when it looked like the economy was really humming and we were going to the new information age much faster than anyone anticipated. Permits got relatively high for this market, peaking out at almost 35,000. Now if you look at where we are in the 2010-2011 time period, we're back to a point lower than any time in the data series going back to 1990. The number of jobs in this market was far fewer in 1990, so we are creating a smaller number of houses for a much larger job base, and this is going to help us rectify any inventory we build up that we're seeing out of distressed, and also keep good demand on new homes once we get just a little bit of confidence back into the economy. If you look at the 5-year forecast here, it's a fairly robust rebound, maybe not in 2011. 2012 is gradually taking off, but we're going to get considerable improvement over time. A lot of the damage obviously has been done in the multifamily. We think in the last cycle, some of the multifamily tended to be Class A REIT quality, condos or apartments, this sort of thing, high rents, high rise in their profile and in their construction cost. Now that single family homes have become so much more affordable, demand just naturally flows to the lowest density alternative. People are taking a single family home in many instances. Here's the employment conditions we talked to just a little bit earlier. On the annualized basis, our 2010 employment is about 1,192,000. If you look back, this market had 1.2 million jobs in 2001 and was over 1 million jobs in 1995. So this is a recurring theme we see across the West, as many of these markets have not created that many jobs in the past 10 years, really a surprising number. You can look to all kinds of policies and different actions that have affected the economy that have kept us from creating that many jobs, and frankly, they're probably going to keep a lid on jobs over the forecast period. Although this market area increases, we pick up 90,000 jobs over the 5-year forecast period. That is not a huge number, and it's going to leave somewhat constrained housing market appreciation and growth, as we'll see in coming slides. Here's the year-over-year economic conditions. As we mentioned earlier, we had some down numbers in 2001, 2002, 2003 as the dot-com played its way out. Then we got a fairly contained rebound in 2004, 2005, 2006, 2007. So those years didn't experience a lot of construction activity, or so much construction activity that we had a huge bubble in terms of employment that would have outlet itself into higher home demand. In 2008, the market slowed down later than most of the Western markets, with the real damage being felt in 2009 and 2010. Over the forecast period, we pick up jobs moderately at first. 2011 shows a little bit of recovery, and then in the out years we start to pick up speed. But literally Denver has avoided the giant spike in employment in the '04 to '08 period. A lot of it based on construction, residential construction, that many areas experienced, and were causal in part to excess demand and runaway prices. Here's our current annualized forecast for fixed mortgage interest rates. I think the most interesting thing on this particular chart is the 2008 number at 6%. As the government became involved in the mortgage market, that number for 2009 is down to 5%. That 100 basis point decline does wonders for home affordability and lets the average household income in this area afford a much more expensive home. That might not have played out on the ground as confidence was down and employment was down, but the supportable home value becomes much, much greater, higher, more affordable when the interest rates drop 100 basis points in a single calendar year. Looking forward, if you go into the forecast, we've got a moderate rise, picking up steam fairly slowly with a little bit of acceleration in the out years. As we sit here today, we can probably thank our friends in Europe and in Greece for keeping demand on the dollar, which is helping us support very low rates. We didn't get a big bump when the government exited the mortgage securities market. The rates came up 20-25 basis points and then immediately started trending back to where they were. So rates are staying low, which will ultimately support us, particularly as the various federal programs for home ownership, they've disappeared at the end of April, and we don't have that going forward, and are probably unlikely to see that going forward. In all the markets we examine, we want to look at the underlying demographics and the population group to group, category to category, age to age. This is 5-year change, so in the categories that are below zero, that doesn't mean we're losing people in those categories. It just means the number of people coming into those categories are less than they were previously. So what this is showing for this particular market area is probably a little less demand, a little less market support for some of the lower move-ups. Not necessarily the entry level, because we've got good numbers in the 15 to 24, but a big group coming down the pipe, coming towards us in the 55 to 64 and 65 to 74. So what we've encouraged, whether or not you're building age-restricted or age-targeted product, especially if you're building primary product, include a floor plan that fits this age group. Many people in this group will not want to live in an age-restricted community and would like to buy in a primary housing community if they can find a floor plan that suits their needs. Also, there's going to be people coming from high-cost markets, the coastal markets, high-cost states, states with poor economic fundamentals, looking for places to retire in states that have good financial structures and good financial conditions. Nobody wants to retire and go to a state where taxes are about to run away, especially after they've maybe on a fixed income.